On February 24th, 2022, Russian tanks crossed into Ukraine. Within 72 hours, defense contractors saw their stock prices surge by an average of 17%. Lockheed Martin alone added $12 billion in market capitalization in a single week. This wasn't luck. This wasn't coincidence. This was a pattern that has repeated itself for over a century, and if you understand how it works, you'll never look at geopolitical conflict the same way again. Because here's what they don't tell you. Modern war isn't just funded by nations anymore. It's designed, financed, and profited from by a rotating cast of industries that have learned to position themselves at the choke points of conflict. Your taxes fund the bombs. Their portfolios collect the returns. And by the end of this video, you will understand exactly how this machine works, the 5 historical precedents that prove it, and the 3 signals that tell you which industry is about to cash in next. I spent 7 years analyzing defense procurement data, tracing capital flows through treasury reports and corporate filings. I'm not here to sell you gold or fear. I'm here to show you the mechanism. This is educational content, not financial advice, but the pattern is so consistent, so brazenly documented in public records, that once you see it, you can't unsee it. Let me show you the blueprint. Here's the map. First, we're going to walk through 1898, the Spanish-American War, where steel magnates turned a 3-month conflict into a 40-year infrastructure monopoly. Then World War I, where a handful of banks financed both sides and emerged as the architects of the modern central banking system. Then World War II, where oil cartels didn't just fuel the war, they controlled which nations could even fight. Then Iraq, where Reconstruction contracts were awarded before the invasion even began. And finally, Ukraine, where energy suppliers and defense manufacturers positioned themselves 18 months before the first shot was fired. By the end, you'll see the pattern, you'll know what stage we're in now, and you'll have a watch list to track the next rotation. Let's start in 1898. The Spanish-American War lasted 113 days. It was sold to the American public as a humanitarian intervention to liberate Cuba. What it actually was a steel acquisition program. At the time, Andrew Carnegie, J.P. Morgan, and a network of rail and steel industrialists were sitting on massive overcapacity. The railroads had been built. The domestic infrastructure boom was slowing. They needed a new customer. The U.S. Navy at the time ranked 7th in the world, behind Spain, behind Italy. That was the problem. The solution was a war that required a shipbuilding program. Within 2 years of the war's end, the United States had become the world's largest steel producer, and Carnegie Steel had secured contracts to build the new American fleet. But here's the key move. The war didn't just create demand, it created the doctrine. Alfred Thayer Mahan, a naval strategist funded by these same industrialists, published The Influence of Sea Power Upon History in 1890, 8 years before the war. The book argued that national greatness required naval dominance. It was circulated to every congressman, every military academy, every editorial board. By the time the USS Maine exploded in Havana Harbor, the intellectual infrastructure for a naval arms race was already in place. The war was the trigger, the steel contracts were the payload, and the profit? Carnegie sold his company to J.P. Morgan in 1901 for $480 million, the equivalent of over $16 billion today. The war lasted 4 months. The monopoly lasted 4 decades. That's the first pattern. Create the doctrine, engineer the demand, capture the contract, extend the dependence. Now let's move to 1914, World War I. This is where the model goes global. In 1914, the House of Morgan, along with Kuhn Loeb and a network of Anglo-American banks, did something unprecedented. They financed both the Allied and Central Powers, not equally, but structurally. In the first 18 months of the war before the U.S. entered, J.P. Morgan and Company acted as the purchasing agent for Britain and France, underwriting over $2 billion in war materials. At the same time, German bonds were being floated through Wall Street subsidiaries and European branches. Why? Because war debt isn't a liability to a bank. It's an asset. It's a sovereign obligation backed by taxation, land, and future production. The longer the war, the deeper the debt, the more essential the creditor. By 1917, Britain and France owed American banks more than they could ever repay in gold. The solution wasn't default, it was expansion. The United States entered the war, not to end it quickly, but to ensure the Allies won and the debt structure survived. And here's the proof. At the Paris Peace Conference in 1919, the same banks that financed the war drafted the reparations framework. Germany was saddled with 132 billion gold marks in reparations. Who financed Germany's ability to pay? The same banks, through the Dawes Plan of 1924 and the Young Plan of 1929. They loaned Germany the money to pay Britain and France. Britain and France used that money to pay American banks. It was a closed loop, a debt carousel, And when it collapsed in 1929, the banks didn't lose. They foreclosed on German industrial assets, and those assets were reorganized under American and British corporate control. IG Farben, Tyson, Krupp, all recapitalized with Wall Street money. The war created the debt created the dependency created the next war. This is the second pattern. Finance both sides, extend the conflict, control the resolution, profit from the reconstruction. Now World War II. This is where oil becomes the dominant war resource, and the cartel model reaches full maturity. Standard Oil, Royal Dutch Shell, and a network of Anglo-American petroleum firms didn't just supply fuel, they controlled the refining capacity, the distribution networks, and the synthetic production technology that made modern mechanized war possible. Here's the detail most people miss. In the 1930s, IG Farben, the German chemical conglomerate, entered into a joint venture with Standard Oil to develop synthetic rubber and synthetic fuel technology. This wasn't charity. This was strategic positioning. Germany had no domestic oil. Synthetic fuel was the only way the Wehrmacht could operate, and Standard Oil owned the patents. In 1942, after the United States entered the war, the U.S. government sued Standard Oil for criminal conspiracy, arguing that the company had restricted synthetic rubber production in the U.S. to protect its German partnerships. The case was settled quietly. Standard paid a fine and kept operating. Meanwhile, Texaco and other American oil firms were selling fuel to Francisco Franco's Spain, which was then reshipped to the Nazi war machine through the early 1940s. None of this is speculation. This is documented in Senate hearings, in antitrust case files, in declassified OSS reports. The oil companies weren't neutral. They were playing a deeper game, fuel dependency. Because here's the thing about oil in wartime. Whoever controls refining capacity controls tempo. If you can't refine crude, you can't move tanks. If you can't move tanks, you can't fight. After the war, the same companies that supplied both sides were awarded reconstruction contracts in Europe and Japan under the Marshall Plan, and they locked in 30-year supply agreements that made European recovery dependent on American and British oil. The war didn't break the oil cartel, it globalized it. That's the third pattern. Control the resource, supply all sides selectively, use scarcity as leverage, lock in post-war dependency. Now let's jump to 2003, Iraq. This is where the model becomes fully transparent, almost arrogant. In December 2002, 3 months before the invasion, the Pentagon's Defense Policy Board met with executives from Halliburton, Bechtel, and Fluor Corporation to discuss reconstruction contracts. The meeting wasn't about whether to invade, it was about how to divide the aftermath. By March 2003, when the invasion began, the contracts were already drafted. Halliburton, formerly led by Vice President Dick Cheney, was awarded a no-bid contract worth up to $7 billion for oil infrastructure repair and logistics support. Bechtel received a $680 million contract for infrastructure reconstruction. These weren't competitive bids, these were pre-assigned. And the justification? Speed, national security, the need for trusted partners. But here's the mechanism. The contracts weren't based on rebuilding what existed. They were based on building what didn't. New pipelines, new export terminals, new refining capacity designed for Western markets, not Iraqi domestic use. The Iraq War wasn't about weapons of mass destruction. It was about repositioning Iraq's oil production within a U.S.-controlled export framework, and the proof is in the numbers. Between 2003 and 2011, Iraq's oil production increased from 2 million barrels per day to 2.8 million barrels per day, but none of that increase went to domestic refining or domestic consumption. It went straight to export contracts with ExxonMobil, BP, and Shell under production sharing agreements that guaranteed those companies up to 20% of the revenue for 20 years. The war lasted 8 years. The contracts last until 2028. The pattern again. Preposition the contracts, create the crisis, control the resolution, extract the revenue. And now Ukraine. This is where it gets current, and this is where the rotation model becomes perfectly visible. If you track defense contractor stock prices, energy supplier margins, and grain export flows from January 2021 to today, you see a setup so clean it looks like a script. In early 2021, 14 months before the invasion, NATO began the largest military exercises in Eastern Europe since the Cold War, Defender Europe 21. The publicly stated purpose was readiness. The unstated effect was a demand signal. Lockheed Martin, Raytheon, Northrop Grumman, BAE Systems all saw orders for anti-tank missiles, air defense systems, and reconnaissance drones spike in the fourth quarter of 2021, not after the war. Before it, then energy. In late 2021, natural gas prices in Europe began spiking due to what was called a supply crunch. Russia was blamed for restricting pipeline flows. But here's what actually happened. U.S. LNG exporters had spent 3 years building export terminals on the Gulf Coast specifically to target European markets. They needed Europe off Russian gas to make those terminals profitable. The war provided the forcing function. By March 2022, 1 month into the conflict, the European Union announced a plan to end dependence on Russian energy. Within 6 months, US LNG exports to Europe increased by 140%. Cheniere Energy, the largest US LNG exporter, saw revenues grow from $15 billion in 2021 to over $30 billion in 2022. The war didn't create the infrastructure. The infrastructure was already built. The war created the demand. And finally, grain. Ukraine and Russia together account for nearly 30% of global wheat exports. When the war started, grain prices spiked. Cargill, Archer Daniels Midland, Bunge, the big four grain traders, made record profits. But here's the move. In 2023, after the Black Sea Grain Initiative partially stabilized exports, those same companies bought Ukrainian farmland and grain storage facilities at distressed prices. They didn't wait for the war to end. They bought into the war. Because they know the pattern. War creates distress. Distress creates sales. Sales create consolidation. Consolidation creates control. The war isn't over, but the land deals are already done. That's the fifth pattern. Build the infrastructure, wait for the crisis, trigger the shift, lock in the dependency, buy the assets. So let me deal with the objections because I know what you're thinking. This time is different. America is too powerful. The dollar is too entrenched. Technology has changed the game. Let me address them one by one. First, America is too powerful. Britain was too powerful in 1914. Spain was too powerful in 1588. Rome was too powerful in 180 AD. Power doesn't prevent decline. Overextension guarantees it. The United States currently has over 750 military bases in more than 80 countries. It spends more on defense than the next 9 countries combined. That's not strength. That's structural fragility. Every base is a cost. Every commitment is a liability. Second, the dollar is too entrenched. The pound sterling was the global reserve currency for over a century. It lost that status in less than a decade after World War II, not because Britain collapsed, but because debt and dependency shifted. The dollar's dominance is based on 3 things: energy priced in dollars, debt issued in dollars, and the willingness of other nations to hold dollars. All 3 are eroding. Saudi Arabia is now accepting UN for oil. China and Russia are settling trade in their own currencies. Central banks are buying gold at the fastest pace since 1950. The dollar isn't collapsing tomorrow, but the foundation is cracking. And third, technology has changed the game. No, it hasn't. The same pattern applies. In 1898, it was steel. In 1914, it was debt. In 1945, it was oil. In 2003, it was Reconstruction. In 2022, it's energy, defense, and semiconductors. The resource changes, the mechanism doesn't. Identify the choke point. Build the dependency. Wait for the crisis. Profit from the resolution. So, where are we now? Let me give you the stage and the watch list. We are in stage 3. That's the quiet rotation. It's the phase where smart money starts hedging dollar exposure, diversifying into hard assets, and positioning for the next energy and defense cycle. Here are the 6 indicators you need to watch. 1. The U.S. share of global reserves. It's currently at 58%, down from 72% in 2000. If it drops below 50%, that's a phase transition. 2. The yield curve. If the 10-year Treasury yield goes above 5.5% and stays there for more than 90 days, that signals loss of confidence in U.S. debt sustainability. 3. The TIC report, Treasury International Capital. This tracks foreign purchases of U.S. debt. If Japan, China, and the Gulf states collectively reduce their holdings by more than 10% in a single quarter, that's capital flight. 4. Energy swap agreements. Watch how many countries sign oil and gas contracts in currencies other than dollars. Every new agreement is a brick removed from the foundation. 5. Gold purchases by central banks. If annual purchases exceed 200 tons for 3 consecutive years, that's a coordinated hedge against fiat currency. And 6. Defense spending as a percentage of GDP among NATO and Asian allies. If it crosses 3% on average, it means they're preparing for a world where U.S. security guarantees are no longer reliable. Those are your signals. The timeline? We're talking years, not decades, but months are too short. The midterm window is 2026 to 2030. That's when debt rollovers, entitlement spending, and defense commitments collide with a shrinking tax base and a fragmented global order. So what do? I can't tell you what to invest in. That's not what this is, but I can tell you the principles. 1, reduce concentration. If your entire net worth is denominated in one currency, held in one country, tied to one system, you have no redundancy. 2, understand duration. Long-term bonds, long-term fixed income, those are bets on stability. If you think we're in stage 3, duration is risk. 3, build liquidity. Cash is not trash if you know when to deploy it. The best assets are bought during dislocations, not before. 4, Own things that hold value across systems, real assets, land, commodities, energy infrastructure, skills. These don't depend on a single government's promise. 5. Diversify geography. If you can, hold assets in multiple jurisdictions. Legal systems matter. 6. Do not leverage into this. Debt amplifies gains, but it also amplifies wipeouts. If we're heading into a phased transition, leverage is suicide. And 7. The mistake to avoid: do not assume the system will announce its own collapse. By the time it's on the news, the rotation is over. The smart money moves in silence. Here's the mechanism in one sentence. War doesn't destroy empires, it extracts wealth from nations and concentrates it in the hands of those who control the resources the war requires. We are in the late stage of the third cycle since 1945. The signals are visible. The rotation is starting. The only question is whether you see it or whether you're the one being rotated out. If this analysis helped you, subscribe now. Drop a comment and tell me, which signal are you watching most? And what do you disagree with? I'll respond to the best ones. This is educational content, not financial advice. Do your own research and consider professional guidance. Thanks for watching.